Hi and welcome to Investing 4.0, Visionary Investing in Future Trends. Now, while I'm working on other videos right now, I just had to upload this spontaneous video. The last week has just been too crazy, so I just have to comment this. What happened basically? The US media announced Joe Biden as a winner in the 2020 US presidential election. A few days after, BioNTech, or BioNTech as you want to call it, I don't know, which is basically a German company that is supported by Pfizer, reported a major breakthrough in their COVID-19 vaccine. And yes, I had to mention that it's a German company because I'm very proud of it. Now, the stock market has just been going crazy. And in addition, now the Chinese government is announcing to regulate internet companies. In this video, I'll break it down and let's take a look at what happened this week. Alright, with all the news, it's no wonder that the stock market is going crazy, but let's break it down step by step. Let's start with the presidential election in the US. So the stock market was waiting for the result of the 2020 election outcome, and in my opinion, it would not have mattered if Joe Biden or Donald Trump would have won. A win of Donald Trump would mean more tax cuts, for example, and less restrictive corona measures, whereas a win of Joe Biden would indicate, for example, a quick shutdown, but better long-term projections and a release in international tensions. So it is no wonder that the stock market reacted to the decision in this race. The general market jumped up, and as I was expecting a Joe Biden win, I bought cannabis stocks. Unfortunately, I decided to buy Afria, which only jumped about 40%, and I didn't choose Aurora Cannabis, which in its peak jumped, I think, about 170%, so almost tripled here. Anyways, shortly after, BioNTech announced 90% effectiveness of their vaccine. So again, the overall market reacted very positively to this news. But then as well, the stocks fell, some of them very significantly. With an outlook of a working vaccine, investors began shifting their capital from tech stocks to value stocks. Now, the result, the Euro stocks, the real estate market, the S&P 500 and other traditional stocks gained and really gained value, whereas tech companies like Tesla, Facebook, Netflix, or even Peloton, The Trade Desk, and so on, declined, some of them up to 15% of their share price. Now, is this a major correction of the strategy? If you ask me, no. All of those companies, especially Peloton and Netflix, benefited highly from the global pandemic. So it is no surprise that these stocks are falling when we see the light at the end of the tunnel, namely a vaccine against corona. I still believe that tech stocks have more long-term potential, but obviously also mean more risk in the beginning. So the volatility as we see it right now is just pretty normal. Going up, down 5%, and then up 5%, and then maybe down 6% and going up 10%, I think is pretty normal for especially tech stocks. This is why I am running a combination of single tech stocks and also my long-term ETF portfolio, which still is the majority. So therefore, I can benefit from the global market no matter what happens. To put it in numbers, for the last week, my trend portfolio lost about 500 euros in value last week, but is almost back up now again, whereas my ETF portfolio gained 6,000 euros. A pretty good deal if you ask me. And yes, I will share my portfolio strategy in the next videos as well. But yeah, I also plan to share specific stock analysis. Now, since the world obviously doesn't like too much good news in a short period of time, the Chinese government announced a regulation of internet companies. I have done a lot of videos and a lot of research, maybe not a lot of videos yet, but a lot of research on Chinese internet and tech companies. So let's have a closer look at what we know so far and what my prediction is. Now, China has new regulations aimed at curbing the power of its biggest internet and tech companies. The regulations suggest increasing unease of the Chinese government with the growing influence of these digital platforms. And to put it in simple terms, the internet means freedom, but the Chinese government likes to be in control. The new rules could affect tech companies like Alibaba, JD.com, the Ant Group, Tencent, as well as, for example, the food delivery platform Meituan. So it's no surprise as the European Union and the US are also talking about limiting their powers of their internet companies. Chinese tech shares were sharply lower after the proposed regulations were released on Tuesday. The news came as JD.com and Alibaba were gearing up for Singles Day, the Chinese annual online sales event, which is the biggest day of the year, similar to Valentine's Day or the Black Friday in the US. So the sell-off continued yesterday, Wednesday, with Alibaba, JD.com, Tencent, Xiaomi, and Meituan all heading lower, losing more than $200 billion combined value. But what does the Chinese government actually want? The 22-page draft by the State Administration for Market Regulation is trying to define anti-competitive behavior for the tech sector and is also reacting to hypes that we saw, for example, during the last weeks with the planned and now delayed IPO of Ant Financial. The new rules will attempt to stop companies from sharing sensitive consumer data, teaming up to put pressure up on smaller rivals, and selling at a loss to eliminate competitors. Also, they want to limit platforms using or forcing businesses into exclusive contracts, something which Alibaba has been accused of by their vendors and competitors. The regulations will also take aim at companies that treat customers differently based on their data and their spending habits. The current status is that they are waiting to get feedback from the public on the antitrust guidelines until the end of this very month. Now, in my opinion, these regulations make sense in order to protect the customer and consumer and put some pressure on the tech giants. Yes, but will this actually limit the growth? If you ask me, the answer is a clear no. These tech companies have way too much influence in China and the population will continue to buy. We can actually observe similar effects in the US and Europe, where the local governments are talking about limiting the power of Facebook, Google, and co. By the way, these plans are not new. They are out there since years, but currently nobody has the guts to do anything as they really fear the reaction from these giants. We also saw it, for example, when Mark Zuckerberg was invited in the US, I think Congress, Senate, I'm not really sure, and had a hearing, but there was basically no outcome and he could have said anything and there was no reaction from the government. In my opinion, China is no different here. Politicians make a lot of plans and say a lot of things, but what is said and what is done is often not the same thing. So I'm also confident that these companies will come up with good solutions to somewhat react to the new regulations if they will actually be enforced and still be able to dominate the market like they have been in the past. What we do see at the same time is that the market in China is growing and growing and growing, so that China overall is not relying on exports that much, which is highly beneficial for Alibaba, JD.com and Tencent if the customer base within China is growing and has more money available. Now, these small bumps that we saw during this week and maybe the last week right now will only be bumps on a long road ahead of us. What do you think about these events that happened this week? Are you still bullish for Chinese stocks or for tech stocks in general? Let me know down in the comments below. As always, please leave a like and help me beating the YouTube algorithm, and feel free to subscribe to my channel if you don't want to miss any of the detailed stock analysis that I've planned and also my regular updates like this. So that's it for now. I'm out.